if you've been living under a rock, maybe you're the only one that doesn't know that your student loans are about to resume payment. So for the past few years since COVID, most people with student loans have been living under this wonderful grace period where they're not having to pay any payments towards their student loan debt. And that's actually been a really good relief for a lot of people. However, a lot of people have been using that money every month to buy, exciting vacations or recreational pursuits or, electronics, whatever. Now they're going to have to allocate that money towards their student loans. And one of the big ways that this is going to affect a lot of people is when they're buying a home. So how is it going to help you or hurt you? All right, here's the thing. Even during the moratorium on payments for student loans, if you were looking to get a mortgage, your mortgage lender had to count some form of payment on that debt. So the average student loan debt in the United States is about $30,000. So every lender has been putting 0.5% to 1% as a payment on that $30,000, even if your payment was zero. So that's $150, it's 0.5%, $300 if it's 1%. Most lenders were doing 0.5% because those could go to Freddie Mac, and that's what most lenders were doing. Now, what's going to happen? Your interest is starting to accrue in September. And then in October, your payments are going to resume. But there's some light at the end of the tunnel. There's a couple things that you can do to mitigate how much you're having to pay, be able to get a mortgage, and then hopefully hammer that student loan debt and get it out of your life forever. So if you have not already, go ahead and pursue an income-driven repayment program, otherwise known as an income-based repayment program. These are formerly, they were sort of predatory in that they were only interest only. So basically you would have a very low payment and that 100% of that payment only went to interest on your student loan. Therefore, most people who had them ended up owing more for the student loan in 10 years than they actually initially took out. That is terrible. That is something that is unconscionable, and in my opinion, the schools should have to pay back, but they're not. The government is going to actually be changing the way that these income-based repayment programs are structured, so here's how it's going to benefit you. Here's the great thing about an income-driven repayment program. If you can negotiate a very, very low payment, then you will be able to qualify for more on your mortgage, okay? What we can do is we take that payment and we offset it against your income, and that we come up with your debt to income ratio along with all your other debts. The higher your debt payments, the lower you're going to qualify for against your income. So the lower your debt payments, vice versa. So you're going to want to have a low payment at least while you're trying to get a mortgage. So go ahead and apply for that income-driven repayment program. But here's a caveat. Do not let them give you a $0 IBR rate, because if you get a $0 payment, then the lender is still required to do that 0.5%. So that's $150. So if you can negotiate something small like $10 a month or $15 a month, $50 a month, whatever's reasonable for you, go ahead and do that. Once you get your mortgage and you get your house, you're going to go ahead and pay extra on that student loan and get rid of it. This is, of course, all understanding, the terms of your current student loan and if it will be forgiven after a certain period of time. Now, if you have not accumulated all your student loans yet, or if you've got somebody who's going to college, here's my tips. I see a lot of people's personal finance, and unfortunately, I see a lot of people with outrageous student loans, and their income just does not support the amount of debt that they took out to get their education. So make sure that whatever line of work you're going into is going to pay you more than your student loan. I think you should at least make 100% of what your student loan debt is your first year out of college. So if you take $30,000 in debt, you need to be making $30,000, right? Unfortunately, I see people with over $100,000 worth of student loan debt who make well under $100,000, and I just don't see them getting out of that debt anytime soon unless a miracle happens. Finally, a lot of debt consolidation lenders are going to be coming out of the woodwork. And right now the mortgage industry is kind of hurting, so these lenders are going to do anything and say anything to you to get you to refinance with them. Now, sometimes it's going to be a better opportunity for you, so you have to look at the terms, but please look at it very soberly. Write it out. Look at the terms of your current student loan debt. How much time do you have left on it? Will it be forgiven? And then compare it to whatever the debt consolidation opportunity that you have is in line, because some of these debt consolidation loans, they're going to be 30 years. And that's, maybe you only have 10 years left on your student loan. Not worth it to take it out. So compare it, ask for an amortization schedule, ask to see what the total amount of interest you'll be paying on any loan ever, so that you can really understand what you're getting yourself into. All right, so if you've got student loans and they've been holding you back from wanting to get a house, or you've been afraid to apply because your student loan debt is so high, give me a comment below. I'd love to hear about it and see if there's something that I know about that maybe could help you. And as always, I appreciate your feedback, so hit that like button and subscribe for more content, and I'll see you on the next video.